country, bringing money into Thailand, what you need to do, how you need to address this. As soon as I posted this on the site for Tiny expats, I don't know if Reggie's here. Is Reggie here? Reggie, whoever Reggie is, immediately said, hey, this is a scam. The tax laws have not changed. Scammers. You know, I was like, Reggie, it's not a scam. It is no new tax law, however, just a different, they're deciphering it differently. So, but quickly, Thomas and I have been doing this type of work for 5 years, and now we're accommodating all the other nationalities as well. And I just want to tell you a little bit about Thomas, because he won't go into that and why we've already been dealing with these type of issues. You know, I've seen some of the videos on YouTube as well, where they say, don't listen to foreigners, don't listen to this. But a lot of Thais don't even know what's going on, even at the revenue department. Maybe Thomas can address that as well with one of our newest reps. So I'll let you hear Thomas.
I'm going to kick the slide off. Thank you, Ken. Give you guys a little bit of background. Again, my name is Thomas Carden. I've been practicing tax, specifically in the U.S. for 25 years, and international tax for about the last 17 altogether. I do have a master's degree in international tax and financial service law, and actually yesterday was the 8th anniversary founding American International Tax Advisors. I really only know that because LinkedIn keeps telling me that each year what my anniversary date is. To this, we are now the largest international centric tax firm, not just in Thailand, but in Southeast Asia at 20. And by this time next year, we'll probably be 40 plus. That's the kind of growth rate we're having. Now, to get you guys into what you want to know, there's going to be 3 things here I'm going to talk about. The past, how it used to work, how it currently works under the regulations, and how it may work in the future. Okay. Now, to start off with this, I'll go through the past way this worked. Okay. If you lived in Thailand to this and you were tax resident, but you're bringing in money from overseas, and that money was in a savings account 12 months after it had been paid, not calendar date, but 12 months after it had been paid, that money was considered savings and no tax was due on this. Okay? Which meant, say you got paid out your pension in the UK, you put it in your checking account, you brought that money into Thailand 12 months later, no tax was due on this. Now, and I'm famously quoted as saying this wasn't so much a loophole as a ship channel. You could drive a cargo ship through this thing in a heartbeat. To the point where no one ever on an individual basis claimed international income on their Thai tax returns. We had one gentleman who got his money out of the US free of tax from his pension, but he brought that in within 90 days. He goes to the tax office in Chiang Mai and says, hey, I'm supposed to be paying tax on this in Thailand. The response from the tax office in Thailand was, leave, we don't know how to do that with it. Only in Thailand you have a tax office saying, we don't know how to collect taxes. Okay, September of last year, shortly after the last government change to this, the new minister came in with the goal of broadening the tax base here in Thailand. Okay, and he looked at this ship channel / loophole and said, hey, let's close this loophole. Now, the minister at that particular point, in my opinion, had no idea of the complexity this was going to be. He wasn't a tax guy, he wasn't a finance guy. He had no idea how this was going to affect foreigners. This was simply a way of broadening the tax base to start taxing this international income. And by the way, even then, I don't think it was really intended to hit the expat community here. It was primarily to hit the wealthy families, and these wealthy families have billions of dollars and euros and all over the world floating around. They have a big tax incentive to have their money overseas invested rather than here in Thailand. This actually kind of pushes them back into Thailand for their particular investments with it. So, as expats, we're all kind of caught in the trap on this, with this, okay? Because the new rules state that the money that you bring into Thailand is going to be taxable, with this. Now, this is where it starts getting fun and complex, okay? Because as with any rule in Thailand, there's about 50 different million ways to interpret things and ways to avoid, I'm not going to say avoid, but to minimize your taxation. How many people married to a Thai wife? Okay. You guys are really, really lucky. One, you're married to a Thai wife, and two, you get to go, you can gift that Thai spouse up to 20 million Thai baht a year, per calendar year. So you could theoretically gift her 20 million Thai baht December 31st, and January 1st send her another 20 million baht with this. Okay, now I'll get questions afterwards with this. So what that means is you can gift, you have to do this from your foreign account into her account here directly. You can't go from a joint account overseas into a joint account. She also cannot give you the money back to this. Once she gets that gift, it's hers to this. So she can't move the money around, back to your name. But she can pay your rent, your housing expenses. She can buy the car. You can drive the car. She can pay for dinner. Incidental use for you is perfectly fine with this. This is the real easiest way to do this. Stop transferring money to yourself directly. Transfer it to your Thai spouse for the household expense. And when I say up to 20 million baht, you don't have to transfer 20 million baht. You can do this 1 million or 2 million baht or 400,000 baht. That's the limit. You don't have to hit that to do this.
So just go through everything on here so I can go to the next slide.
Okay, so we got the slides back up. Sorry about that. Okay, now we'll go to tax rates here. Revenue Code Section 41, Paragraph 2. A person who receives a foreign source income resides in Thailand with 180 days in the tax calendar year. A person enters Thailand in the 2024 calendar year and the subsequent years. Verification individual is obligated to disclose his income brought into Thailand when calculating the income tax rate for the year. Okay, that word obligated means you have to file a tax return to this. Okay, secondarily to this, we actually just got clarification on this. Non-filing of a tax return right now is not, under current rules, a deportable offense. Okay, but not having a Thai tax ID number by the tax rules is a deportable offense with this. So, weirdly, and that's actually been in the code for many years. It's not having a Thai tax ID number. If you're here 180 days, they've never enforced that. But if you're not filing Thai tax returns, they can theoretically kick you out because if you don't have a Thai tax ID number with this. Non-filing returns. Now, what will more than likely happen and what they're talking about, since they haven't put this in place, is the first thing they're going to ask on renewing the 90-day visas stay, for a 90-day stay, is at some point they'll ask for that Thai tax ID number with this. Now, if they will not grant you the 90-day reporting unless you've got that Thai tax ID number, this is in the future, not currently, and then you have to go get the Thai tax ID number, but you're on overstay. Right now, before the big rush, it's taking 2 to 4 weeks to process a Thai tax ID number. And if you go 30 days over, you start getting reporting overstays and on and on. You get a Thai tax ID number in advance with this. Now, I don't know about the office here in Udon. Has anybody ever gone and gotten a Thai tax ID number if they're in the office?
Those left power buttons.
Yeah, so before this meeting, the reason why I've organised this meeting, I've actually spent 32 full days in Udon Thani tax office. And one thing I will say straight away, they're very friendly, very helpful, but they know nothing. There's one guy, he knew about the agreements between the different countries, and he was the only one. One guy who was waffling on for about quite a few minutes. But that's it. But I would say, yeah, the tax office here basically knows nothing hardly. They haven't got the latest brochures from Bangkok, got nothing. That's it.
This is a real common issue with this. Yeah. Okay. One of the things we've done is we've set up a service to get Thai tax ID numbers with this. It's 7,000 baht plus VAT for us to do it. We're able to do it with a power of attorney in the central office in Bangkok. So if you can't fight them through here to get this tax ID number, you could use us as a service and get these things. They do limit us to 10 a day applications, but the central office in Bangkok is issuing them through this. But that issue of what the local offices know is really, really common in this. We've had some people in some offices go into the office just to get tax ID number. It rolls through 15 minutes. Other people, 2 to 3 weeks of fighting the bureaucracy. And it's not even just that particular office, it's that particular person you are dealing with on that particular day. The Thai government has done a poor job of disseminating information about what's coming up with Franklin. Now, for a long period of time, I had thought that they would actually push this back by a year because the regulations and bureaucracy are not in place. When they changed power here just recently, though, within 7 days, the new government had affirmed that this was the rule and it was going to go into effect and that you have to file a tax return on the first for next year. Go ahead.
So Thomas, so the first point there is the 180 days.
Yeah.
Can you cover that?
Yeah, the 180-day rule is pretty much standard worldwide. 180 days in any country makes you tax resident in that country. What that means is you're there as a tax resident. You're not going to be a permanent resident, but you're subject to taxation on your income. And by international treaty rights, that country will generally have first rights to tax you on income you earn in that, and then potentially taxation on global income with it. So, so this is also a little bit of the exception here too. Okay. Anybody looking at buying a house or a condo in the immediate future with this? Do this? Okay, not so much in this particular room today, but should you choose to do that, say I wanted to bring $3 million bought in to buy a house, and you're looking at a taxation rate of 25% on that, you'd have to bring in $3.75 million to cover the taxes on that. What you can do, though, is stay in the country less than 180 days. If you stay in country for less than 180 days, you are not tax resident in Thailand by the rules and able to bring in an unlimited amount of money into Thailand in your name. So use the 750,000 baht, take a very nice couple of cruises, and go to Bali or back home for a couple of months with this, and just stay out of Thailand for 6 months and a couple of days. That's one of the big exceptions to this. With it. Okay, now we're going to go in a little bit on this one. This next slide, common reporting standard. Anybody heard of common reporting standard? We got one. That's unusual. That's 2. Okay. For the Americans in the room, anybody familiar with FATCA, the Foreign Account Tax Compliance Act? Do this? Okay. The FATCA effectively, starting about 14 years ago, forced all international banks to report all American account holders back to the United States Internal Revenue Service. Not a fun thing to do it, although it's been very profitable for my business growth, because every expat now has to deal with U.S. taxes much more formal than they did before. Can't really get out of it. Common reporting standard is basically called son of FATCA. Okay, in that a common reporting standard country now has access to all the banking information of residents who have for other common reporting standard countries. So if you are a Briton here, not only does Thailand will have access to all the financial information you have through the revenue department in the UK, all the way down to your bank statements as well. To those. Australia, France, Germany, Canada, many countries are all subject to common reporting standards. So the idea that you can hide money and bring money in with it is not really going to work with it. And part of what is all happening here for Thailand specifically is they're wanting to become a bigger member of the OECD, Organization of Economic and Cooperation and Development. Not very popular, apparently. No. Do this. The OECD is pushing very heavily at the behest of the Biden administration, primarily leading this, to try to equalize tax systems around the world. Do this. And Thailand is being pushed into this. It's not even just a domestic policy to this. Internationally, they're trying to be pushed into this with a move into global taxation. Now, global taxation is the next stage of this. That's stage 3 to this. Global taxation means that no matter where you are, if you are in Thailand, no matter where your income is earned, Thailand will begin taxing that money to this. But you have to use the tax treaties to see whether or not that income is taxable in the United States or in Thailand. to this. And if it's taxable in both, where the money comes from in the first place, we'll have the right to tax it first. And then Thailand will have to give a tax credit back for that money. So let me give you the two examples of this. Okay. A lot of Americans in here? Raise your hand, guys. Okay. I got good news for you guys overall with this. Okay. The first bit of good news is if you got an IRA, a 401k, a simple Roth IRA, you're not a federal government employee in the retirement systems of this, the U.S. does not have rights to tax those funds. Okay. You can withdraw out of your pension systems free of U.S. tax with this. Okay. That's part of the tax share. Now, if you aren't remitting it under current rules into Thailand, that money is free of tax. You're in Thailand because you're not under a global tax system. However, if they move into a global tax system, that money, when you withdraw it out of the U.S. pension, will be not taxable there, but taxable here, unless you do some more advanced planning, which we can talk about later on with this. In fact, I'll go ahead and do this. Ken and Lee, raise your hand. These guys are the people who help you do the financial planning and set up structures. They help you minimize your tax break. Okay. So now, so you can do that. You could be free of tax in the U.S. Do this, and what you can do is you take that money out under current rules, leave it in the U.S. bank account. But if you've got the Thai spouse, you gift it to her, and guess what? You are not subject to taxation because you are not remitting it in. You're giving it as a gift to your Thai spouse, and you are free of tax. Now, anybody have a long-term girlfriend but not yet married? Do this. Very common thing to do this. Bit of really good news. There's a very, very thoughtful Thai gentleman who gave his long-term girlfriend 14 million Thai baht and went to court here in Thailand to state, hey, similar to common law reporting, I had an obligation to treat her like my wife because we've been together for 10 years. I should get the 20 million baht exemption. And guess what? He won. So you can gift your long-term girlfriend up to 20 million baht without any Thai tax issues, should you choose to do that. Yeah, to this. So again, that money can do this. I'll go ahead and answer one question.
If you have two girlfriends.
Honestly,
taxation is the least of your problems.
I'll try to find a slide that Thomas is talking about, but for relatives, you're allowed to gift 20 million baht per
20
year.
million baht and
Yeah.
actually 10 million baht to any other individual out there. Do this. So you can gift anybody in Thailand 10 million baht to be free of tax with that. Now, one of the, I talked about this a little video we did earlier, one of the questions I get all the time is, oh man, I'm going to gift my car dealership 3 million baht, they'll buy my Mercedes, and he'll gift me a car. Well, technically, that doesn't work because you're getting an economic value and it's not a gift. And the bigger problem with it is the car dealer has no legal obligation to give you the car after you sent them 3 million baht. And I highly doubt you'd get the car with this.
Some of us, we'll get on the.
Okay, so just to give you guys things on this, when you do remit money in, it does become taxable. Here's essentially the tax rates. It steps up by 5% in each increment to this. So up to 150,000 baht, you have no Thai taxation. Now, that's not
per year.
Per year. That's not the threshold to have to file a tax return, weirdly. The threshold to file a tax return is 60,000 baht of income, either in Thailand or brought into this book. So if you have 60,000 baht of income with this, you have to file a Thai tax return, but you'll be 0% tax. And then it steps up. 150,000 to 300,000 is 5%, and goes 300,000, 500,000, all the way up to 2 million, 5 million, you're 30%, above 5 million, you're 35%. Now, if you're European and most of your sources of income are coming out of there, generally you're going to pay a higher tax rate in Europe than you will here. The good news about that is if you're being taxed in that one in Thailand or in the EU somewhere, and it's at a higher tax rate than it is here, you can bring that money in because the tax has already been paid in Europe. Do this. And in some cases, it works the same way in the United States. You can do this each way with this. One of the keys of this is proper planning greatly helps you to deal with all this. But the next slide on this will actually show the tax numbers. Do it. So, you start to show. So at right at 5 million baht, you're 1,265,000 plus 35,000 above 5 million baht. So, you know, this is what your actual tax numbers would be if you're getting any one of these properties. So it's graduated. Everything hits at 5% is taxed 150K below. So it doesn't. You're not paying tax on the entire 35% at that tax bracket because the earlier tax brackets are taxed at a lower amount. Weird mathematical thing on this. So now, one thing we get to is a question of possible deductions on on Thai tax returns. As Americans, especially, we're used to being able to deduct almost everything in certain things, but the Thai tax code is very, very simple. It's almost a flat tax as far as deductions are concerned. You're not really going to be able to deduct dental and all this kind of stuff with it. There's very, very few exceptions. They're going to lower this. Other than if you are working, you can put into the various provident funds with this. You know, so you can save money if you're working, but if you're a retired person here, you're not really going to work on this. Now, okay, let's go through. Any Aussies in the room? Okay. Aussies. Okay. I know we've got some Brits. How many Brits in the room? Okay. Let's see. Any Swiss? You got a Swiss gentleman, right? Okay. Canadians? I'm about to ask Canadians. Although, do I need to end everything with the statement A?
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 No, that's US.
Okay. So, actually, our Canadian gentleman is the luckiest guy in the world here, except for one small fact. Your Canadian pensions are not taxable here in Thailand. Both government employee pensions and private pensions, including old age pensions, are not taxable here. The bad news is you have to pay higher taxes in Canada and you would pay here on them, so you're kind of stuck that way.
So can they get it sent here?
You can get your pension sent here. You have to file a tax return stating this is not taxable, but there's not going to be a tax event because only Canada can tax your particular pension with this. Okay, I'll go back to the United States citizens a little bit on this, but this is all by tax treaty. Okay, United States citizens, private pensions are not taxable. Government pensions, if you're a military retiree, anyone military retirees in here? Okay, your pension is free of Thai tax, taxable only in the United States. Social Security for Americans is also only taxable in the United States with this. The majority of Americans are going to be living off their old age pension. It's a specific thing to this. So there, you're free of tax in that situation. For our British friends, do this. Government employee pensions with this. Dave was a veteran of the British military. That pension would be free of tax here in Thailand. You can bring that money in an unlimited amount with no tax issues. Now, a private pension where you were not a government employee and the old age pension system that they have, their equivalent of Social Security, is taxable only in Thailand with it. So in that particular case, you have, and same thing with the U.S. private pensions, you have to go back to that country, source country, and say not taxable in that home country, only taxable here. So, you know, we do a lot of work with several of the European accounting firms to sit there and tell them, hey, this is not going to be taxed. We have to do this. We had one gentleman who was an Irish gentleman who has about 4 million euros trapped into a pension account that was overfunded by his company to this, and Ireland wants to hit him for millions in fines for having this overthink to this. We're starting to work with his Irish firm now because guess what? Only Thailand has the right to tax that. So Ireland can't only not tax him, they can't punish him for being overfunded either to this thing. So he's going to save a lot of money. What he'll do is he'll do some advanced tax planning and be able to bring that money into free of tax as well. Okay, Swiss gentleman with this, the same situation. Government pensions, if you're a government employee, not taxable in Thailand, taxable only in Switzerland. Private pensions, taxable only here. Aussies, can I get Aussies to this? Yeah. Okay, Aussies, you guys really need to talk to us, okay? Because unfortunately, for you, it's the same situation. Government pensions are not taxable in Thailand. They stay taxable only in Australia. But your superannuation payments that are probably not being taxed are not taxable in Australia, but taxable in Thailand with this. Now, The way to do this is, and this is where planning really becomes into it, okay? One of the easiest things to do is if you have enough income, you can qualify for the LTR visa. Anybody familiar with the LTR visa? Okay. The LTR visa, under current rules and regulations, says you are not taxable here in Thailand under the LTR visa. You have to have a certain amount of income and passive income on a regular basis flowing into that to be able to qualify for that LTR visa. In that particular case, if you are an Australian super, you're not going to have to worry about it being taxed in here and the current remittance rules and even potentially the global rules if they move into this. So the LTR visa protects you, but subject to change because the LTR visas are going to be changed year by year on year on what they're saying. One more bit of information. Now, secondarily to that, the way to really protect yourself is to begin to use high-level tax planning. And this is the best way to do things in most cases on this. Okay, when you start looking at tax treaties, you can begin to really use them for your advantage. And we've all heard about how the super wealthy use tax planning strategies around the world to lower their taxes dramatically. What we've done is we've tried to move this into the average person with that. You can set up a Hong Kong pension, Lee's kind of the expert on this, fortunately, part of the reason he's here, and legally move your assets into that ownership of that Hong Kong pension. Now, the benefit of that is, from a Thai standpoint, is under the current tax treaty with Hong Kong, Thailand cannot tax those pension distributions. And get this, Hong Kong, under their laws, because you are not resident in Hong Kong, they cannot tax it either. Now, everybody freaks out, oh my God, Chinese government, blah, blah. That's not really what's happening here. This is a contractual placement set up for the structure. You can still have the assets held in Interactive Brokers, which is a US-based brokerage firm. You can have them held in Australia exchanges, the UK exchanges. Their assets are really still yours. They're still there out there in your name. They're just shielded for taxation violence. So, especially in the Australian superannuitization system, what you would want to do if you don't have the LTR visa, move your assets or your income into that Hong Kong pension, and then bring the assets in free of tax as well. Bring the income free of tax.
And we just mentioned that Thomas is talking about the Hong Kong pension that we offer, but your assets are not held in Hong Kong. It's kind of through the contract for the tax agreement in Hong Kong. So the assets could be held in Guernsey or Isle of Man or Mauritius as well, but your assets are not in Hong Kong.
I mean, one quick question.
Yeah, two questions on the LTR. Do you need to hit a tax number, and also do you need to file a return even though you not paying?
Right now, they've said no return with this.
How about the tax?
Okay, tax ID number they have not clarified yet.
Okay,
So,
thank you. That's for the LTR.
yeah, if you're on the LTR.
Doesn't that breach the OECD regs though? You know, if the LTR guys have been told there's no tax, that's going totally against what you were saying that the OECD is pushing.
I agree completely, but this is one of the weird conflicts that happens here in Thailand. In fact, one of the things they set up was the DTV, the digital nomad visa, that came into effect. And we want these digital nomads coming into them here because digital nomads didn't like this place to be able to stay with this. And they want to stay, don't have to go in and out every 90 days with this. But then right after that, they came up with this series of rules, which will subject these guys to tax, which is literally being counter to what the DT visa was supposed to be doing in the first place. You're correct with it, but this stuff does, especially when you come to government policies, one side isn't talking to the other, and on and on to it. I mean, if anybody has an older elite visa, and I believe older in about 5 years with it, many of the older generations of elite visas had a rule that said you were not subject to international tax on money coming in too with it. Those are getting rarer and rarer that some have them. Although I've run into people who, 25 years ago bought a lifetime elite visa. At one point those existed, but there are still 20-year, 10-year visas out there, elite visas that have the same rule into it. But they haven't done that in the last several years. Right now, the LTR visa does shield you, from taxation. But again, those are renewed each year, and that can be subject to change. The way to really formulate yourself is stay less than 180 days, gift to wife, or start using the international pension structures to allow you to minimize your taxation, and or look at your individual tax treaty where you're from. I mean, one of the things about this is if you guys are getting IRAs and 401k distributions living off of that, You can go back the last 3 years and file amended returns back with the United States and get refunds on all of that tax paid if you were a resident here. The largest amount we got in past refunds was $1.1 million from the IRS as a refund on past pension distributions. So, and how you bring that money in just becomes very, very important. Planning on this makes a lot of difference to this. I've always said, compare international taxation, the difference between a clock and a meat grinder. Anybody know what that is? Okay. It's actually two sets of gears and old analog clocks and a meat grinder. The difference is that with a clock, all the gears mesh up perfectly, works, and you get your steak dinner at the end of the evening. In a meat grinder, the gears are slightly off center, and you get hamburger at the back end of this instead of steak with this. If you do proper planning, you'll mesh all your gears together and you'll minimize your taxation with it. That's really, really key to this. And one of the things we do is we offer a free half-hour consultation for anybody who's here to this. You can call into the office or we can do it by Zoom. With this, we are here for several hours more as well today, if you want to speak afterwards. But come in and talk to us about your individual tax situation, and we can get you guys specifically on how to move forward with this. Now, a lot of guys are going to try and go through the thing of, I'm not going to get a tax ID number, I'm not going to file a tax return next year with this. And that will probably work next year, too. But will it work the year after when they're forcing you to do this for immigration, and then they say, you got to go back last year and get your tax return done too, because you were supposed to have done it then, you're in a situation. It's just a matter of time. I mean, how many people here are long enough where they didn't have the health insurance exemption to it, that they now require for different visas to this? There are a lot of guys at the bar saying, yeah, I'm not going to get that health insurance thing here. They're never going to actually require that. Those guys aren't sitting at the bar anymore, guys. Do this. If you are here for the long term, you want to be conservative about this, because at some point they're going to keep tightening the screws and you will get caught. And you'll probably get caught when you go in to do 90-day reporting and or renew whatever visa you happen to be on. Caution in this secures you to be here.
And just addressing that point that Thomas is making, that these are new interpretation of the existing tax laws started January the 1st. This is something that's happening now. So even posting in some of the groups that were coming here today, a lot of people say this is not, there's been no change in tax law. There is no new tax law. However, there's a new interpretation that started January the 1st. And Thomas, maybe you can address the existing issues, assets that were held before January the 1st.
Yeah, this gets real confusing. And again, to give you guys a change on it, was literally that 1 year rule that changed. And before they didn't interpret it, the previous revenue minister came down and said, no, we're reinterpreting that rule now for the savings issue. Now, there was a lot of debate on whether that was going to withstand court challenge and stuff, and apparently it has with it. So, this is going through. We talked to the Thai Revenue Department on a regular basis. They're like, this is a done deal with it. In fact, we thought that when the new Thai government came in, they may postpone this, which honestly would be a little bit of a sensible thing to do. But within 7 days of the new Thai government coming into power, they reiterated that this is how it's going to be with it. Their constituency is not people with international income. It tends to be poor rural farmers with this. So they kind of want to go after the rich families, and they're doing that into this. We are bycatch in this. Okay. Now, the January 1st date is a really important date on this. Okay. Because remember that word income being taxed, income being taxed, income being taxed. Okay. Savings is not going to be taxed. But under current rules, what that means is that if you had a cash account at the end of last year with it, with say 250,000 pounds in it or 250,000 US dollars overseas, and it's some type of savings account, including checking accounts, you have a real cash account, even a brokerage account that has a cash account in it, you can bring that money in free of tax as well, up to that amount with it. You can't refill it and continue to do that. It has to have been in that account as of December 31st. Anything from that point forward will be considered income. Now, one of the catch-22s of this is how much of that's going to be income and how much of that's going to have been principal initially invested in it is kind of an open question on how it ties taxes. And let me give you an example of this. We have a gentleman who came in last week, actually about 2 weeks ago, who has a UK rental property that's rented out by a Canadian company, and the money from the Canadian rent for the company is paid directly into his Thai bank account. But he also has a mortgage on that property of 1,200 pounds. So he's bringing in 3,000 pounds a month, but he got an expense against that income of 1,200 pounds. Okay? So we went to the Thai government and we asked the manager at the local office, will he be able to deduct the $1,200 pounds and only pay tax on the 1,800 pounds with this? The very nice gentleman at the office gave us the firm answer of, we don't know. So we were like, well, we're gonna have to do some type of rental income tax return for this. And they're like, send us a formal request on this question. We have 29 formal requests right now in progress with the Thai government asking very questions. But theoretically, and by standard Thai rules, if you were to sell something and say a house somewhere and bring that money into Thailand, the only portion that would be taxable is the income or the profit above what you paid for that house. We don't have the policies yet on how to justify that when the property is overseas, but the income is supposed to be taxable. The principal investment into it is not.
What about business?
Pure capital for investment is not. If you're going to invest in a business here in Thailand, is
No,
not.
I'm saying you sell a business.
You sell a business, again, cost basis would be deducted from the income with it. And the regulations on trying to do the cost basis are going to be very difficult. Really, if you've got a really complex or a high dollar amount, you need to talk to Lee Stephen and Ken and flow the money through the Hong Kong pension. That's going to be your safest way to try to do all that.
Hey, we'll have the slide. Let's go through the gift tax again, Thomas. This one in the next slide, I think.
Okay. It's 20 million baht per year. Okay, and if you were to exceed that, the recipient has to pay a tax rate of 5%. Okay. An immovable property, you can give real estate to a Thai with it. Family maintenance gift, descendants or spouse, up to 20 million baht a year, so you can gift your kids as well. Non-family members, 10 million a year, and free of tax as well is purpose-specific gifts, education, religion, or public benefit. So gifts to your children to pay tuition are accepted from this as well.
I think when you do a gift, Thomas, do you have to do the official form behind that, or?
No, right, and this is going to be, right now, there's no real reporting on gifts, strangely enough, under the current old forms with it. They are supposed to be revising the new forms, and especially add up several sections on international taxation. The P&D form is very, very basic, but they're expecting a lot of revisions on the international stuff because this had never been done. One of the big questions of this next year is, if they don't get that done, how do you begin to report all this stuff? And that's part of the reason why you have to come to a firm like ours, because we're working with the tax revenue office on this. We have, I have staff pretty much every other day go to the Thai tax revenue office in Bangkok, the central office, to ask informally questions. And then when they give us the standard we don't know question, to ask them formally. Answers are starting to come back now from, I kid you not, the head of legal for Thai revenue. That's who the people who have to answer this stuff is. It goes all the way up to the top. And unfortunately, those answers aren't really flowing into the regional offices. So if you go to ask somebody here in a local office, they're not going to know about this. So, my name is Thomas Carden. I'm the director of American National Tax Advisors. We are by far the largest specialist firm in doing this. We do give you guys a half-hour free consultation. Unfortunately, my schedule is pretty chopped up at this particular point. We have staff members that help you out for all the nationalities of doing these things, and we can try to get you as efficient as possible. Most people in most situations, you're going to pay the same tax you would before. This is a paperwork issue. We're trying to do a standard charge of $400 per US dollars for doing a Thai tax return for you guys with this, unless you start getting into really high level stuff, you're trying to sell a business, I'll bring it into it. But most standard returns should be around $400 US dollars for filing this thing. We also charge 7,000 baht to get a Thai tax ID number. I highly recommend you attempt to go down this calendar year to get that Thai tax ID number, because when this starts getting to be required next year, the offices will be overwhelmed and they are understaffed and underpaid as it is now. But you can come into our office and do this if you do have a problem with this. Get this handled now. And if you do want us to do a Thai tax return, indicate now. We've got a capacity of somewhere around 4,000 Thai tax returns to do with our staff, and there's 400,000 Thai expats here in Thailand. And where the other 396,000 people will go, I'm not sure. My biggest fear next year is that 12,000 people try to do this all at the same time with us. It's going to be chaotic and not a fun process next year, and probably something you will not be able to go in and do on your own because these offices just aren't going to have you do it for now. Should you choose not to again, you may slip through the things on this. You may slip through the cracks, but if eventually you're going to have to backfile to this year, that will come down. If you're just here for a short period of time, you may or may not choose to worry about this. But if you're planning on being here for a long time, you're going to have to handle this. By the way, one thing about this is the way that most of the rest of the world works. There are very few countries that were the old system of the international income with non-tax. Vietnam actually is still one of them. You can move to Vietnam. It's still just the domestic tax system there with this. Vietnam is now on their 4th prime minister in 2 years with it, and they are in political chaos right now. And my clients there, a satellite office, are not real happy with what's going on, the chaos that's going on in Vietnam right now. If you think it's bad here, it's worse than there right now. Cambodia actually has global taxation, and so does Bali, Indonesia. We have a nice office there. So if you're thinking about going somewhere, there's not a lot of choices for back into the old system with this. Even the Philippines is a global tax system with it. Money coming in the Philippines is taxed there. Okay.
So I just want to say real quick, Thomas is our American International Tax Advisors, and Lee and I work for Business Class Asia. We basically financial advisors and pension specialists and things like that. Thomas, over the last 5 years, Thomas's wife helps them recruit accounting majors into learn American taxes, and the one intern in this company and going to stay with us to do American taxes. But we also, during that time, for Americans that, our American clients that have businesses, we've always been doing Thai taxes as well. So now we have a Thai tax team as well as a higher level grade individual to help us go to the revenue department to get actual answers. So anybody here today, as well as anybody on the YouTube channel, the San Farang, Thomas together we do appointments, free 30 minutes to call us and answer any questions and learn about your own situation. So you can give us a call. We'll set up a Zoom call to do those, and answer your particular questions if you have them. We are located in Bangkok. Feel free to come into our office. We're in the same building next to Landmark Hotel. And we also work out of, we have an office at Pati as well, in Viutile 5 that we just opened up. So we're down there a couple days a week, all of us. Lee is usually lives in Pati, and he's there as well all the time.
Zoom, Skype, all the different varieties of business contact as well. I actually am in the United States towards the end of the year, although I'm assuming Lee and Ken will probably be coming up here, Udon as well. And thank you guys for all coming. We weren't expecting this large of a crowd, so we had to bring in extra seats as well, you know, to this. And, okay, now start with the questions.
Can I ask specific questions?
Last time, if anybody gets bored, this was an hour and a half process of specific questions.
Just a couple of questions. You mentioned earlier on, if I heard you correctly, the UK pension is only taxed in Thailand.
Government, yes, for regular pensions is only taxable. So
What-
if the,
We have two pensions in the UK, but the private pension and the government pension.
Yeah.
Both are taxed in the UK.
this is where this gets real fun.
Yeah.
You
They're
have
both taxed in the UK at 20%.
You have to go back to your UK accountant and say, I'm resident here in Thailand, and deal with the UK government and say, you are not supposed to be taxing that, only Thailand is able to tax it. We do work with accountants who handle this with it, but you have to go back in and specifically deal with the UK government, because they're not supposed to be taxing. Now, if there were no, sorry about this, okay, I'm correct on the UK tax. Sorry, I may be incorrect on the UK, because the UK does not say only to this. The only thing they have is a government pension, talking about mentioned with this. The UK is one of the exceptions to this. In that particular case, the UK would be taxing it, but you get the tax credit here, because they don't have, again, trying to memorize this stuff, it's a little bit difficult. But government pension is only one listed by the UK system, not a private pension or old age pension, which means I was incorrect earlier on that.
Yeah.
UK taxes, Thailand has to give a tax credit for the taxes paid in the UK.
There are some people that don't pay tax because they're allowed to earn that £12,500
Yeah.
for as a
But
personal allowance. But
Thailand would then tax, even regardless of that it wasn't taxed in the UK. Now, there was one bit of feedback on this. At one point, one of the ministers said, this was in the old government, that income that's not taxable in one country via the tax treaty will not be taxable in Thailand as well. So theoretically, this would mean that Australian super is not being taxed in Australia. It would not be taxed here. However, that is not a rule or regulation in effect at this particular point. Right now, that would stay fact, because that's an only situation. But the UK is one of the rare examples that it only talks about the government pension, not the private pensions, which would mean the tax credit issue with that. I was trying to get, I got across a little bit on that one. So.
My second question is regarding the money that you bring over.
Yeah.
I'm just looking at a slide from the Revenue Department.
Yeah.
It says on here, foreign sourced income derived before the 1st of January 2024 and remitted into Thailand in a later tax year is not subject to Thai tax.
That is that December 31st rule.
Right, okay, so for example, if you have, say, a pot of cash in the UK that is a lot older, or it's not been generated in 2024.
Yeah.
Before that, and you bring that money over,
It's
not taxable.
it's free of tax.
Okay, so
Same
how does one
as the
prove that? How does one prove that to whoever's expected?
They're right now, they're telling us they want a bank statement showing that balance as of December 31st of last year. So some type of financial statement proving that balance should be sufficient to do it. Then it comes into savings.
Okay, so if you've got a bank statement that says it's got, say, £100,000 in it, and it's generated prior to 2024, you just produce that statement, and any money you transfer across is deducted from that amount. So you can show that every time.
That's how it's working. Now, they're specifically telling us that statement has to be the end of December. So you couldn't go in and say, I had £100,000 in January of the year before, I can bring that money in. You have to have showed, a very, very recent statement towards the end of last calendar year to be able to do it. But that money will not be taxable just this year, it will be taxable ongoing. So if you did have money in a cash account, that money is taxable from the ongoing future until you zero that balance out.
Okay, that's good, thank you.
Now, does that money have to be brought before the end of this calendar year?
No, it's
So anytime in the future.
an ongoing issue.
As long as you can produce a statement.
Like it showed, that was the balance you had in some type of cash or savings account or equivalent system to it for saying that will be ongoing and not taxable.
I would also say that I've got the feeling, I've heard something that it was like this year, that it would not be continued next year, like the assets, I don't know. You know, if I were any of you guys, if you're gonna bring some money in from those accounts, I'd bring it in this year.
Yeah.
Just to be sure you're not gonna have to do that.
Rules and
So-
regulations in this are subject to change, but right now, they're saying it's ongoing, but.
And Lee and I, we have a client now, we just, a British guy, we transferred some money in, 500,000. And we regularly have to prove where money comes from. So we have to provide a statement, maybe a transfer slip or something like that. We do that now for other people. So it seems like they're asking more, but this is very common for the things we have to do, even for non-Americans. You know, for Americans, definitely have to show where the money came from, before, after, all those kind of things. But even for non-Americans, we have the same kind of requirement when we move money around.
As far as the UK goes, if you've got some money coming in the future from inheritance, and it's already been inheritance tax didn't apply in the UK, how would that work?
Inheritance are okay, by current rules, and this is a little bit of an obscure thing with this, the inheritance will not be taxable to you. If you can prove that's a distribution, it's effectively a gift to you and should not be taxed. What's going to be required to show that, we don't know yet. The good news for the Americans in here, the Brits, the Aussies and Canadians with this, they are stating they are going to accept English language documents without having to be translated. Germans and Swiss and the French would have to have the documents translated by a licensed translator into English with this here. Into Thai. But right now, they're saying that, you know, if there's some sort of legal distribution proof that you've got that this money came from an inheritance, it will not be taxed either. Actually, look up here. I'm sorry.
Just a quick one, on the gift tax thing, does the gift have to be sent from overseas?
Yes, yeah, well, no. If you have the money here in Thailand, you can gift it to your spouse, no issues with this. But that's not beating the remittance rule.
Yeah.
Do this. The money's already in country. This issue doesn't occur to it. If you're talking really that you want to use the gift for money from overseas to avoid the remittance basis of taxation here with this. So yeah, you can gift money that you have locally here, but if you bring the money in from a UK account or overseas account into your account here and then move that money in, they're going to tax you first on the remittance, and then it's not taxed as a gift. It has to come from a foreign account in your name to the Thai spouse without going through your account here, because then they're going to say you brought that money in income, it's taxable. Then after that tax, you can give it to your spouse free of tax. But the way to avoid that tax right now is bringing it in from an overseas account.
Will the spouse need to file a return?
Not at this particular moment. There's no, believe it or not, there's no declaration under current forms, but we're highly suspecting that that's going to be a thing on this, because this is going to be one of the things around this. There's going to have to be some type of declaration. Well, again, the Thai tax reform is one page. It's too bloody simple for what's going to happen. Put this gentleman here first.
What about use of foreign credit cards?
Okay. I'll give you a firm yes, no, and a maybe on that one. To it. Okay. Under current rules, foreign use of credit cards and hitting the ATM is not a taxable remittance in the Thailand. Good news. So you go to dinner, you pay for your groceries, you're shopping with your credit cards, your ATM cards. They're not going to count against you on that. Okay. However, there is a very specific international term for anti-money laundering called structuring, which you can't really live off your credit cards and your ATM things off this, because if you're doing that, you're doing small transactions that structure yourself in order to avoid taxation and reporting. But can you use them for incidentals? Yes. But at some point, you're going to have to justify how you're living here. And if you say, I haven't hit my ATM card, you're going to run into anti-money laundering rules as well.
Okay, if you're gifting your partner though, then surely you sometimes using your credit card, you should be sort of covered.
Yeah, it's as I said, if using the money on that right now is not against the rules and not, to this. Aggressively doing that could get you in trouble. That's kind of the best description to it. And some of these things, international tax, it's like painting a picture. I pulled out of the ATM $500 to give to her, no big deal. If you're going in every day and pulling out the max you possibly can and trying to avoid taxation, you're probably going to be in trouble. There's not a set standard on that with it. But again, now we have been told that even if you are not required to file a tax return, at some point, because you didn't bring in the income, you're below the threshold for this. The Thai tax revenue has the right to pull you in and make you justify why you didn't have to file a tax return. Guilty until proven innocent, so to speak. One of the things we're saying to a lot of people is you can play this one of two things. You can play this hard and say, hey, I'm not going to do this at all if I'm below the threshold and do all this. Or you can be very conservative and say, I don't owe any money to Thailand, but I'm going to go ahead and file a tax return just so that a year and a half or 2 years later, they don't call me in and then you have to pay me at several $100s an hour to go in and talk to these guys and say why you didn't have to file a tax return. You're probably cheaper to file a $400 tax return just to prevent yourself from having to do that. That came down very hard from the Thai Revenue Department. Yeah, they may not be required to file a tax return, but we still have the right to bring them in and make them prove that they didn't have to file a tax return.
How does it work with gifting your Thai wife with your joint bank account from England?
We're advising against that. Okay, put in a specific name of it. Now, theoretically, that's possible to do, but the paper trail is not as clean with it. And so in order to make this clean, that's what you're always trying to do on this, make it into a joint single account. It's arguable, yes, I put that money in my joint account and gifted it to her here, but the chances of having to argue with the Thai Revenue Authority about that is much more substantial than it coming from an individual.
The reason I did that is in case anything happens to me, it's easier access for her.
And although I can talk to you, one of the biggest issues we have is sophistication of Thai spouses with this. One of the big advantages of the pension system that these guys have is upon your passing away, you can state exactly where that money goes by your wishes. So you could have she would come in with a death certificate, give it to these guys. The money can go to her fairly immediately. You can give it the whole. You can say, I want it to go month by month by month with this. They'll probably do another couple seminars in here specific on these type of topics. But one of the big advantages of this planning is you can take advantage. You can do tax planning for your Thai spouse in a much deeper way, and even all the way into your kids and potential grandkids. If the gentlemen here are lucky enough to have a Thai spouse, no. Probably society-wise, that what will happen, you've been here a long enough time, the woman gets a fair chunk of money, the rest of the village goes after her to get every dollar she can out. She's got obligations to have to do this, and she's out of money within about a year because all the money's gone and none of the family members ever paid her back. You can set up the pension trust in a way, she gets tax-free income, and it's going to come on a regular basis. She might lose the first 6 months of income, but then she learns pretty quickly it's not coming back to her. This is, up until recently, this is the big number one reason why they've been doing the pension trust to this, specifically helping out with your Thai spouses.
So keep in mind, your wife, when you transfer that money, she's the one that has to do the tax return showing the gift. So Thomas probably can explain his way out. I mean, right now, if it's husband and wife.
Yeah, but anyway, you're specifically talking about coming from a joint account.
Okay, yeah.
Right now, there's no designation of a Thai tax form that you got this gift for less than $20 million. There's nothing reporting on this. But the revenue is talking about redoing this form by the end of the year. And that's probably going to be one of the things they do. But Thai bureaucracy being what it is, we may still be the same form for another year. Who knows?
So what Thomas was touching base on is through Business Class Asia, we have a couple of different trusts, pension trusts, actually. So the pension is set up to hold your assets, but it can also, if God forbid, the worst happens to you, can transition into a trust. So the majority of our clients, you hear all the stories here in Thailand, but a lot of people here have, they love their spouses and girlfriends and things like that, want to make sure they're taken care of. Thailand does not recognize they don't have any kind of trust laws or anything like that to make sure that they are taken care of. And these type of products do that.
with a couple of other benefits. So the more writing you do with that, the more, the more things you can do. So if you want to make sure she's taken care of and get us that salary, if something happens to her, she can go to the kids. If something happens there, you can go back to the United States. So the more you do with these kind of products, the more you get out of them.
You can split the beneficiaries. You've got kids back in your home country and kids here. You can split it in, between the two of them.
And for Americans, there are tax benefits for us as well as British. I like to always say, for 5 years we've been working with Americans, trying to accommodate us. Our account, as soon as you change your address on your regular banking or your pension, they're going to close your account in a lot of cases or restrict it. So these are solutions that they really need, and going forward that they really want to be able to protect, and have the same assets really in these type of pensions that they have at home and can possibly be tax advantage. So we're taxed while we're alive. And I'm gonna ask Lee to come up because the British guys and other nationalities, you guys have a bigger tax issue for me that I see, because you guys are taxed once you pass away with the death tax, and a lot of guys that have run into, you think you fully 100% domicile here. You guys have this new, government coming in, they're changing the rules and things like that. It's no charge to talk to Lee about this stuff, but I definitely would invite you to make sure you talk to him to be sure that you don't have any assets. Even the Canadians, to avoid taxation, you have to give up your driver's license, right? You have to give up your driver's license.
I have them.
You still have it?
Yeah.
When you're still taxable in Canada, like you would be anyway. But to avoid taxation, you have to give up your
Everything.
everything for Canada. So different nationalities have different rules. And invite you to call and talk to us about them, as well as how these plans work to benefit you.
Yeah, thanks. Okay. So the Soteria pension plan, we started in 2016, mainly for retirement purposes for young people. People our age, it was mainly estate planning for people from the UK. So anything that goes into the pension, before the change in the Thai tax system, we looked at saving inheritance tax. Immediately it goes in. Okay, so there's no potentially exempt rules. You haven't got to wait 7 years for it to come out of your estate. Immediately it goes into here. It's out of inheritance tax. It comes out of probate. No creditors can get at it. So if you've got an ex-wife chasing you, she can't touch that money. And it pays no capital gains tax on your gains. So worldwide tax system in Thailand, you wouldn't pay tax on the gains. Now, what it did at that point is it fell under the UK Hong Kong dual tax agreement, which said that pensions are taxable in the jurisdiction which they're based, which in this case is Hong Kong, and they tax it at 0. Okay, so anyone from the UK under the dual tax agreement, if you move back to the UK, you can get income from your pension or capital, take it back to the UK, and you don't pay any tax. Okay, so from a UK perspective, you don't pay 40% inheritance tax. Okay, you've got no probate administration fees or lawyer fees. You've got no capital gains fees, and you can draw an income in the UK under those rules. Now, we've been doing this since 2016, very successfully saving people money. I have had people pass away holding this. Okay, the money got to the wife within 14 days, not 6 months going through the will and probate. Okay, and as our American friends here just said, you can dictate how you want your money distributed. So in a lot of cases, people here are on a second marriage. They've got children from their home, their previous marriage, maybe living in their home country, but they want to make sure their Thai partner is looked after. So they'll pay the Thai partner an income for life. And then once that income is no longer needed, the capital that remains will pay their children from the previous marriage. So you can dictate how you want it. Now, when the Thai government announced that they're going to start taxing on a remittance basis, okay, we looked at the Thai Hong Kong tax agreement because we didn't need it before because there was no tax payable, and it says exactly the same thing. The pensions are based and taxed in the jurisdiction where they're held. okay? And they can't be double taxed again. So it helps for that. If they bring in worldwide tax, then you're protecting against capital gains tax. Okay, now this is a full occupational pension scheme under Hong Kong rules. It's regulated and registered by the MPFA there. I lived in Hong Kong for 15 years. I don't know if anyone else has been there, but the MPFA is the Mandatory Provident Fund Authority, which is the Hong Kong pension regulator. Okay, so it's fully audited under that, and that's how it falls under the DTA. It's not because it's a trust, it's because it's a pension. Okay, but it has all those other benefits with it. We do have other trusts coming out of Hong Kong that may be appropriate in some cases, because being a pension, there are some restrictions. But looking at most of the people in the room here, you're going to be above 55, so those restrictions won't come in and affect you. But this is a very effective way to plan not only for retirement, not only for growth, but literally we set this up to look at everything from a different perspective. How can we save people tax? How can we make sure that the beneficiaries get it easy and they get as much of it as they possibly can? That's why we set it up. But the Thai tax system and the worldwide system, this is ideal. Because technically, it's what we call a non-vested trust. So if you think of a normal occupational pension from the UK, you pay your money in, somebody else holds it, somebody else looks after it for you. But when you get to retirement, you receive the benefits. And when you die, you receive the money back. And this works in a very similar way. So someone else is looking after your money. The reason you don't pay inheritance tax, probate, is because the member of the scheme has passed, but the scheme is still existing. So as far as the government's concerned, the person holding the money hasn't died. It's just a member, and then the member dictates where that money goes. Now, the other thing that we do very successfully, is if you've got property in the UK, whether you're there or not, whether you're domiciled in the UK or not, any assets in the UK are subject to UK inheritance tax. So if you've got £1 million property in London, which you rent out, you've never been to the UK in the last 20 years, you severed all other ties, you will still pay tax on that property. Okay, so again, we have pension structures based either in the Channel Islands or Malta or Hong Kong that can physically hold your UK properties. And what we do is we put the property in a company, we put the shares into the pension. Okay, that means that any rental income starts getting taxed at corporation rates rather than personal. So you drop from 45 to 25. But the benefit being is any assets held in that, again, pass free from inheritance tax to your kids, okay? And you can continue after death, okay? Now, the other benefit from a Thai tax perspective is if you've got £1 million property, you put it into the pension, the £1 million actually has to stay in the pension. You can't bring that out because it's under pension rules. You can bring out portions. Okay, but what you can do is do a director's loan from the company for the full amount. So you sell your property, the £1 million stays in your pension, you do a director's loan from the company to get the £1 million, and loans coming into Thailand, and so Thomas will clarify this, if you bring loan money into Thailand, that's not taxable. So again, you're getting around the Thai tax system. You're saving 40% in the UK, and you're saving the tax rate here when you bring the money in. So all these different things we can help you with. We also look at life cover to protect inheritance tax and other different matters. But what we focus on is estate planning and tax saving. And that's why this works so well in Thailand, the UK. For our continental European friends and anyone under Sharia law, you have forced heirship rules. Your money has to go in certain proportions to certain people. This pension trust takes it out of those laws. So again, you can distribute it any way you want, and you're not subject to forced heirship or Sharia law rules. Okay, so that's it.
Any more questions?
With respect to capital gains out of the US, I think for this most recent tax year, we're allowed up to $86,000 or $87,000 in capital gains. And still possibly pay zero capital gains tax in the States. Will it be subject to capital gains here? Even though
There's no such thing as capital gains tax. If we went back to the slide of ordinary income tax rates, that's how it works. So,
even though I'm not required to pay there, I may be or
if
will be.
you bring that money in here, you'd have to pay capital gains tax. There's no such thing like an 18% or 15% capital gains tax here. It's taxed at ordinary income rates. So yeah, if you brought the money in here, even though you're not subject to the U.S., yes, you'd be subject to capital gains tax here.
But if I don't bring it in,
you don't bring it in, no taxation. Now, what you can also do,
what
though,
about,
is
I mean, when you're talking about worldwide income, I mean, that's income, is it not?
worldwide yes, but that's
I don't know.
the system they haven't moved to yet. But this is the really powerful reason why the Hong Kong Pension Trust works, because I'm sure as an American, you're familiar with a Roth IRA. You put the money in, you don't get a tax advantage, but you get tax-free income. If you were to say you go sell those assets and you don't bring them into Thailand, let's say you sell $200,000 worth of assets. You don't bring those assets into Thailand, but you then place it into the Hong Kong Pension Trust with it. You move it back into Interactive Brokers. Two things are going to happen. No longer subject to capital gains tax, and any money that you remit into Thailand from that point on in the future is free of tax as well. So you can begin to shuffle your assets. This is not an all or nothing. You don't have to go move everything into a pension trust at once. But as individual assets mature and want to move and sell, you sell, take the capital gains hit, move into the pension trust, and from that point on, any income flowing out of there is free of U.S. tax because it's the pension and free of Thai tax. Planning.
Since we started hearing about this at the end of last year, I've started separating.
Yeah.
And I'm going to hold those monies. I have some royalty income as well.
Yeah.
I'm putting it
royalty incomes are taxable by the U.S. Thai tax treaty at only 10 or 15% from memory. So you got if you do your U.S. tax return properly on that royalty income, it actually gets a reduced income rate in the U.S. Not fully like the pension stuff, but yes, it is a reduced rate.
But I'm keeping that income in a separate account.
Yeah, that's fine.
I'm not bringing it in.
Yeah, but that's fine. But when you do your U.S. tax return, you're still subject to the U.S. terms of the Thai tax treaty, which means you get a reduced rate on that U.S. on those royalties in the United States by the tax treaty, even if you don't bring it into Thailand. So instead of paying 25 or 30 or 35% on that royalty rate, you claim the tax treaty benefits and it'll lower it down to 50. I believe it's 15%, but it might be 10. Trying to remember all these rates.
I don't think I'm paying that kind of royalties because it's on Schedule C, or Schedule E as supplemental income, and it's dumped in with personal income, I believe.
Yeah, personal income. If it flows to your personal income tax and you don't have any other deductions against it, your K1 may flow that in a way to where you've got expenses offsetting it. Oil royalty income.
Yes.
Yeah. So oil fields will have expensive depletion credits as well.
15%.
Yeah. So your depletion credits. So, but the still net of that is going to be taxed at ordinary income rates.
Yes.
So any net above those depletion credits will be taxed at ordinary income rates. But that ordinary income rates would flow down to 15% by the tax rate.
Fortunately, I sold my wells 2 years ago.
But what to clarify, we go through this a lot, and again, one of my buddies is here, and I think it's kind of unbelievable. The tax treaty between the United States and Thailand not only benefits Americans, but can also benefit non-Americans that hold assets, retirement assets in the United States. Okay, so typically, Thomas, you can talk more about it, but
we got a lot of guys who anybody in the oil industry here? Do this, couple guys. Do this. We got a lot of guys in the oil industry who work for U.S. oil companies who have 401ks trapped in the U.S. Everybody keeps telling them to get 30% tax if you pull that money out. You live in Thailand, you can pull that money out of those 401ks free of U.S. tax. Don't bring it in Thailand, free of tax. You can remit it into the Hong Kong pension and then flow the money through. One of the things about this is you can use that Hong Kong pension properly as a conduit to flow the money into under current rules because you're not under global taxation. But prior to global taxation, if that comes into effect, you want to move as many assets into that shield as you possibly can because then it would be free, even the movement. After global taxation comes into effect, you can no longer move an asset in because you're subject to global taxation and sales and stuff. You'd have to sell it, pay tax here in Thailand, and then get the tax benefits on the income. If you do your plan before that comes in, you save your tax.
Just one thing on the Hong Kong pension, under the rules, you can't withdraw money for the first 12 months. So you need to make sure you keep sufficient money out to live off to carry you through.
But you fill that bucket, you can continuously fill that bucket up and then pour out at the same time after 12 months. So you put the first batch of money in the first 12 on January 1, you start pouring that out January 1st of next year, but you can pour the other income into it. And because it's last in, first out situation, so you're able to do that with the Hong Kong pension.
So the tax treaty, again, any American or non-American, if you have a non-federal retirement, okay, the tax treaty actually says the country you live in has the only right to tax your income from that retirement. Even if you've taken a withdrawal of from your 401k to IRA for the last 3 years, you need to talk to us, because you're paying taxes when you should be. Now, Thailand could have collected these taxes all along. That's the interpretation. And the biggest thing to Americans is that now they are going to collect those taxes. Thomas actually had a client that went down before and tried to pay the taxes. And they said, we don't have an idea how to pay. We don't even know what we're talking about, see you later. But these taxes are actually, they're actually collecting these taxes from non-federal retirement now, brought into the United States. But technically, the United States does not have the right to tax those pensions.
You can get,
Subject to
under
that
statute
tax
of
rate.
limitations, you can go back right now and redo your 23 tax return, your 22 tax return, and your 2021 tax return, and get those taxes paid back as a refund to yourself. Because the U.S. does not have rights to taxes unless you were a federal government employee to us. We get a lot of very happy people when they start getting large checks back.
Like I said, when I'm out talking to people, the police officer, the fireman, these guys retired here are non-federal employees, and they're paying taxes in the United States, and they do not owe taxes there. They can file what you're saying in the last 3 years and get all the taxes you paid for the last 3 years, something paid back from you from the IRS. It's a big deal.
So if you have a ref,
Sorry, repeat that?
a ref account,
Not quite familiar.
so I can't take my money up until I'm 65.
Yeah, you're gonna be, sorry, you'll be subject to the same rules in Canada to this. So you're still, if it's 65, yeah, if you're 65 is the minimum in Canada, the Thai rules won't help you out in your situation because it's only taxable in Thailand. If it were, only taxable in Canada. If you were the other way around, where it was only taxable here in Thailand, you would generally be able to take it out free of the tax in Canada. But you're stuck with the 65 rule in Canada.
But again, if the Americans are not subject to that, they
The
can
Americans
take the
are not
money out, they can take the penalty, they cannot charge you taxes on that for the penalty.
Here's the wacky thing about this. So most Americans are going to have Social Security taken out with this. So if you take $100,000 of income out of a 401k, you got $100,000 taxable income. You're making $25,000 of Social Security each year. $20,000 of that becomes taxable to you. You're being taxed on $120,000 of income. Now, when you do the tax treaty math and you eliminate the $100,000 tax on the pension or the 401k distribution being taxable, there's no taxable income to go against that Social Security. It makes it free of tax as well. So you can arrange your math in a way that eliminates the tax on the Social Security too, with this. And get this, you can still bring that Social Security money into Thailand free of tax, no issues whatsoever. In fact, for the Americans in the room, here's the easiest thing to do. If you are making $30,000 a year of Social Security income, you bring that money in up to that amount of money each year by your 1099 SSA, and you don't have any tax issues here in Thailand. You just have to file the tax return.
One more thing that we run into is that the teachers that are here working in Thailand, the ones that have children here, for Americans, and filing taxes, 2 ways to file if you're working with the foreign earned income exclusion, which basically just wipes out your income. But typically what we find is that the tax rate is higher here for working parents, working American parents. So if they actually just file taxes normally and they have children here, they actually will pick up the child tax credit.
Additional child tax credit.
Additional,
Most teachers who are living here, we get $1,400 US per child back each and every year, as long as they have a social security number with it. So if these teachers making $16,000, $18,000 a year, they'll get a check back from the US government for $2,800 for 2 children.
we told her we ran into a young family that were running into difficulty. They had 5 kids, and they were here working. I think we were missionaries as well, working here, and so they got a child tax credit for 5 kids for the last 4 years, because they caught us right when you filed taxes, and they got the previous 3
Save their
years.
house, the refund saved their house.
Yeah, so it's free to call and ask a question. If you guys have any questions, Isan Foray, please call in. You get a free 30 minutes consultation with us. Take advantage of it.
One last question. I got 2 more. They got 2 hands.
I thought the child tax credit only applied for if you lived in the US.
No, that's the reason I clarified that. The child tax credit, yes. The additional child tax credit, no.
Oh, the additional.
Last question.
Earlier this year, I was in the middle of a tsunami of selling companies, selling assets, moving assets, and I was confronted with this new tax situation in Thailand. I want to ask you, I'll tell you what I did and ask you if you think I'm insane, because I couldn't find any simple answer to the question. I just caught an airplane, went to Phnom Penh, got a 1-year retirement visa in Phnom Penh, got a house, got my driver's license, got my bank account, and decided, right, until the dust settles, I won't be in Thailand for 180 days. Is that an insane thing to do?
No, it's actually it's not the most pleasant thing to do, especially if you got a wife and a family here.
Yes.
But no, I mean, in fact, that's probably the #1 reason the way that the wealthy Thais are avoiding this. A lot of these guys, Thais tend to love Swiss chalets with this, so they're spending a lot more of the ski season in their winter chalets and avoiding the global tax situation on this. They have the clout and power to do that, and it's a valid thing to go do. However, especially if you're selling companies and you have substantial assets, you don't necessarily have to do that. You can go in and move the assets into a pension trust and not have to worry about this for the rest of your life.
That was the second question.
Yeah.
So,
That's your alternative to have to doing this.
yes, but if I move these assets there, do they just sit there doing nothing, earning 0 a year? Or
No. They're investable. You're able to go into any type of listed stock you want to.
Yeah.
Crypto is allowed in certain circumstances with things. You have the ability. With the trustees have to do, and Lee's going to speak better about this, but trustees have to make the decisions on. So you tell the trustee what to do, give them instructions, and they sell. So this is not really something you're going to sit there on the computer and be able to do day trading in a 5-minute increment with it. But yes, your assets can be held there, but you're really in the classic situation of, I don't want to do this pain in the ass of going back and forth. But by the way, I love Cambodia. I spent a lot. We have a satellite office there. There's the best pizza in Asia. Is Brooklyn Pizza near the Russian market. Just so you guys know, and liquor is really cheap in Cambodia, too. But going back and forth on that sort of an endless visa run situation is just not any fun. You can avoid that and set yourself up to be insured from global taxation. Any questions about that you want to go through?
Yeah, so basically the trust is like a wrapper, right? It gives you the tax benefits and it does the administration. Now, within that, we would put in whatever you want to hold in it. So if you've got a portfolio bond, for example, which will run out of the Isle of Man or the Channel Islands, we just do a deed of assignment. So you keep the bond exactly the same. All that happens is the name changes, right? So instead of being John Smith, it's Soteria Worldwide Trust for John Smith, right? But you still give the instructions. So the trustees do all the administration, but they only do what you told them to do.
Could I, for example, if I had an account with Interactive Brokers, I say the money in that account is completely the trust's, but I will manage the trades.
Yeah, so what we can do in that situation is we can hold it. We have a series of portfolio managers, so you can put the money with them. You can move your existing investments in by selling and rebuying, in some situations, or sometimes it's in specie. We just move it in, like I said, by deed of assignment. Okay, now, if you want to run your own platform, we can go to the trustees and we basically get them to agree that you can make all the changes within it. They're just responsible for the whole thing. But what we would do is you might have to hold two different platforms within your trust, right? So one of them would hold everything else, and you have the right to run the platform in the middle. If you've got a regular savings plan, for example, or an existing portfolio bond, you can add to them. A regular plan still comes out of your bank account. It's just held within the trust. Okay, we do fixed income for a lot of elderly people that want to boost their income levels. So we do a 2-year investment that they select. It pays roughly 10%. That money can come out and pay into their bank account, but the capital itself is protected against all the taxes that we talked about, as well as the income payments coming over here. So it's basically an open-ended structure. But, you know, if you tell them to put all your money on the 315 in Happy Valley, the trustees will say, sorry, that's too risky, right? And they will protect you on your behalf then.
Okay, thank you.
But I would add that all investments, the platforms can hold any investment that you're holding right now, because
I'm loud enough.
we can put that, in our investments come out of our Hong Kong office.
And the other thing is as well, because it's in Hong Kong, everything in there falls under Hong Kong regulations, right? So in Thailand, when we do our job here, there aren't really regulations, right? I mean, people tend to do whatever they like. Everything we do is subject fully to Hong Kong regulations. Everything that we do is held at the Hong Kong office. So you have the full backing of Hong Kong regulations, which is some of the most stringent in the world. And if you know Hong Kong, the education system is just literally, they never question, they just do it, right? So if there's a tick box, they have to put that tick in the box, and they will not do anything, even if it's common sense. You cannot get around that. They will go, nope, I need that tick in that box. You've got to provide this, right? So again, it's kind of frustrating, but it's there to protect you, because they make sure everything's 100% before they'll actually do it.
The thing that gets me about the British stuff is that we found or read that, you know, the IHT rules that you think you're domiciled somewhere, and the British government has come back and said, well, you know, he kept his membership at the country club, you know, and he was planning to go back home. So, yeah, his property is subject to IHT, which is 40%, something like that. So the thing is, protect yourself, talk to Lee about those assets. If it's better to hold it there, you know everything is done. And then you have some extra writing in terms of how you want your succession of assets. You don't want it to judge in Thailand or the UK or United States deciding about your situation, you know. So if you don't do that, we know we should do it at home. We know we need a will. I think we do wills as well. Do what you need to do here. We can help you with all that stuff.
The other thing is, I do come across it, I'll get you in a minute, do come across it quite regularly. You talk to people and they're like, I'm not domiciled in the UK, I've been offshore for 25 years, I've never been back, right? And then you go, okay, how long have you lived in Thailand? Well, I moved here 3 years ago. Well, what happened when you moved out of the other country to here is you revert back to the UK, because you have to be domiciled somewhere, and then you need to build up your years in your new country of domicile. So if you pass at that point, as far as the UK is concerned, you're still UK domiciled and fully subject to tax. So what you have to do, under the old rules, this is changing now, but you have to establish your domicile of choice. And if you change that domicile of choice, then you revert, and then you have to rebuild. Okay, so you can be subject to tax just if you move country. Now, again, that will change, but they've also changed the years you need to be offshore. It used to be 6, now it's going to be, you've got to be 10 years offshore. And stupid things, if you have a house in the UK and you go back and you stay there 1 week a year, okay, and the rest of the time it's empty, or your family living in or whatever, you have made yourself domiciled again, because you're using that for your own personal use, and the UK government will just go, okay, you're keeping it for your own benefit. You obviously plan to come back. You haven't established your domicile of choice. So little things like that, going back for healthcare. can actually affect your domicile. And small, the tiniest little things you would not believe, they can try and get you. And if it's worth their while, and the government in the UK at the moment is, after every penny they can get, they're going to get you. Now, the other thing, just quickly before I pass to you, the budget in the UK is on Monday. They're seriously looking at hitting capital gains tax, inheritance tax, domicile, and a lot of other taxes. The big ones they're going to hit, inheritance tax, capital gains tax. They're the ones that affect overseas residents, potentially. Okay, so.
Is there an administrative fee for this trust?
Yeah, the fees themselves, for what it does, it's actually quite minimal. So for the first year, you pay an establishment fee, which is £250. Okay, you'll pay a reporting fee because they have to basically update your details once a year, £250. And then for the first year, for the trust, you pay another £250. So your first year fees, £750, probably about $1,000 US. In year two, so after 12 months, you pay the £250 reporting fee and then 1.2% of whatever assets are held within in the structure. Okay, now for substantial monies, that fee can be reduced down, and we can also cap it. So for example, you're putting 2 million, we might go, okay, it's reduced to 1%. Okay, so that's 20 grand a year. We will cap that until you get to 5 million, right? And then it will drop to 0.8, and then we'll cap it at that until you get to 10 million. And after 10 million, maybe 0.6, and cap it at that figure, 60 grand. And then that's all you're going to pay from that point onwards. So depending on the values, depending on what you've got going in there, we can adjust that. But for anything under probably 2 million, 1.2%.
I'll finish up here with two nightmare stories that inheritance occurred. The first one occurred a couple years ago where commonly, as we all know, you can't own land here as a non-Thai, but you can own a house in it. So the house was in the husband's name, the property was in the wife's name. The husband passes away without a Thai will, and the wife is like, she was able to live in the house, but she didn't want to live in the house because she didn't own the house. She was scared to live in a house she doesn't own, even though it's on the property she owns. One of the weirder things you can end up with here in Thailand. A basic will would have changed that pretty dramatically. Both Ken and Lee do help out with Thai wills. That's part of the business planning here. Get one of those things. But even worse, we had a good friend of ours who was in Chiang Mai. And really nice conservative guy. He had built up $1.5 million in his IRA that he never really touched. Just, let it go, let it grow, and let it grow, and let it grow. Never touched this. But his health was declining, and he had a beautiful Filipino wife who was also here as well. And he knew the issues with his wife, the family and stuff. It would not be that secure if he did this. It takes a couple months to get these things in process. Literally about a week before the money transfer was supposed to be done and this thing was finalized, he passes away. So we go back and we talk to the wife and we say, listen, you really need to continue this thing and set the pension trust up now in your name. They wanted to. And within a week, her statement was, no. My family in the Philippines wants me to buy a bunch of chicken franchises to spend $1.5 million on with this. And you're like, you're probably not going to have any chicken left in about 2 years as these people have sucked all the money out of us. But that is exactly what happens. The family goes into these women and sucks it out to us. Planning will help you minimize your taxation, increase your quality of life, and guess what, guys? Help your heirs out. And it doesn't have to, the whole $1.5 million, he didn't have any previous children, but in a lot of cases, you've got the issue of you've got one family in the U.S., one family here. How are you dealing with this? There's no Thai trust laws. You can set it up to say, these kids get this, these kids get this, and it flows very nice and fastly. And one of the big benefits of this, especially for a Thai wife, she doesn't have to dealing with the U.S. and trying to get money out of IRAs and 401ks. And let me tell you, we charge generally about $2,000 to fight with the brokerage companies in the US to allow the Thai spouse who's supposed to get that money within a week, and it takes 6 months to a year before that goes into it. And now the brokerage companies are coming up and saying that spouse has to get the IRS to clear the final tax return and state that there's no taxes due before the brokerage companies will pay that back out, and that's a 1.5-year process. Meanwhile, your spouse is sitting there going, what the hell am I gonna live off of? I'm supposed to have this $1 million out there, or $250,000, and she can't get access to it forever. It's all perfectly legal. One last question.
I'm sorry, can I go back to that house example?
Yeah,
In my case, a girlfriend, she
Yeah.
owns the ground.
yeah.
I build a home. If I don't have a will and I pass away, what happens to the house?
She's got a legal limbo fight going. She's stuck in legal limbo for an extended period of time.
Okay, does the Thai government come in and say, hey, you don't own the home?
I was just gonna say, the other way around, what if your wife dies and you're still alive?
Yeah.
And her family own the land that your house is on and they don't let you get to it.
Okay, in my particular example, I hired a lawyer and I've got a will.
Okay, have you got a long lease or a usufruct?
I've got
on
a
the property?
30, I went to the, whatever, the
Land office.
government offices, and I've got a 30-year.
Okay, so you've got a long lease or a usufruct.
Yeah.
Now, the long lease, you've got the right to live in it, but in some cases, you don't have the right to stop the family living in it as well, right? And they can make things really difficult. So-
Well, in mine, I put provisions that if we, say, for example, we have a fight, she can't kick me out.
Okay.
But
If she passes away, her family maybe can move in, I think that's your point.
yeah.
Oh, okay.
So I'm glad, what I was getting
Yeah.
to, if you've got the long lease, you've got the usufruct in place, you're protected as you possibly can be.
Okay.
But if you, many situations, people just buy a house, put it in the wife's name. The wife tends to be younger in most cases. So we always assume we're gonna die first, she gets the house, right? But one of my clients, his wife got killed in a car crash, right? She owned the house. Now, under Thai rules, he's not really got any right to it, right? Because he's probably number 6 or 7 down the list, right? So the family moved in, he went off to work, come back, and they were like, it's not your house anymore, take your stuff and leave. Now, just getting a usufruct or a long lease, or ideally both, and even if you've got your property in a company, which is not technically legal over here, get the usufruct, get the long lease as well. Because then you're protected, because you have the 30-year right to use the land and the 30-year right to use the property.
So in my case, do I need to do anything else other than that?
We'll talk to your lawyer, but it might be you need the thing about the usufruct is it kind of comes in once you already own the house and once your wife's already got the land.
Okay.
So she has to agree to sign that, right? And often the family don't want her to, right? So if you go through the process with a lawyer and then your wife or your partner refuses to sign, well, you still got to pay the lawyer, right? But you actually got no benefit. So you need to get that agreement from them before you go through the process.
Okay.
The long lease you can set up before you purchase. Okay, but you do the usufruct at the same time. We have an excellent lawyer up here who works with us called Paul. He's mainly up in Phuket, but he sits on all the estate agency boards and he deals with the land department and he's very well into this. Technically the rules in Thailand are foreigners can't own land and whatever you do to get around that is deemed illegal, right? So all the property companies that own the property, technically they're not legal. And they are hitting them for the Russians now. So putting those things underneath it means you still have the right to live there, right?
You can buy a house or property under your business or something,
Yeah, but who owns the business? The business has got to be 51% Thai owners as well, right?
Unless you do have treaty A, any company. Honestly, if you guys are interested, we can do a series of these things. One of the things we can do is bring up a Thai, possibly Paul, Thai legal expert. We can also do an estate issue to this. There's so many different topics in this that can be done. But yeah, but you can also, again, call Lee or Ken and have a direct conversation with them. we can also refer you to the attorneys who can help you with all that.
Okay, just one thing about the will, as Ken said, we write wills. Okay, now, a lot of people have got wills in place. A lot of people put their brother from the US or their brother from the UK down as the executor, right? Or their children or whatever it is. Okay, now, they may have never been to Thailand. You've passed away, they're gonna get here, and chances are you've never actually told them what you've got, right? You haven't told them what bank you're with, what branch it's at, what your account number is. So having a will is the first step. But what you need to do is have something alongside that, so that if an executive from overseas turns up here, he's got a big list of everything you own, where it is, how to find it, okay, where the bank's based. You don't have to put amounts, but have an account with Krung Sri Bank, account name, account number, account branch address, and just list it. Right now, we have a form that goes alongside the will. We call it the departed form. It's about 10 pages long, and I'm perfectly happy to email it to anyone in this room if you give me your details. It goes through everything, who to contact, okay, where your bank accounts are held, what social media accounts you have that need to be cancelled, where the deeds to your house are, where the mortgage is. All those things are listed. So if you do happen to pass, they turn up, they get the will, and they don't miss anything. Right? If you've got an offshore bank account, have you told anybody? Because if you haven't, that money is never coming back, right? And the bank will keep it after a couple of years of it being dormant. So just write it down. Getting the will is the first stage. Preparing someone to actually implement it is the important bit, so nothing gets missed. And if you keep that outside the will, buying and selling over your lifetime does not affect the will. You just change that document to suit what you've done. Okay, but keep that in mind. Even if it's just your wife and she's down as executor, does she know everything that you got? Okay, I had a client who passed and he said, I've got nothing here. I've got a motorbike, I've got a car, I've got a couple of bank accounts. I've got loads of stuff offshore and it's all on my computer. So my sons can just find it. Right, well, what he didn't do was tell him his password.
Yeah.
Okay, so, you know, writing those things down. Now, often, we don't want to leave passports, ladies present here, but we don't want to leave passwords to your computer because maybe you don't want your partner to see what you're doing or what you've got.
Ken has
So-
standing rules, we have to run over his phone with him.
Yeah, we have to, we've got to run over it with a car, burn it, and then drop it into the middle of the ocean because of the stuff on that. But, I mean, his girlfriend can never ever see that phone. But, you know, you need to make sure that people have access. Now, you know, I've got someone that I've just done a will for, everything's in his safe. I'm like, well, who told you combination? Oh, I haven't, right? So you put your brother down as an executor, right? He lives in the UK. He cannot access your safe, so tell him the combination, right? If he needs to come here, he can get at it. If you need to, put it in a safe deposit box, stick it in an envelope, right? Only to be opened by my death, you know, and put the details in there. But, you know, or like I said, put it all down on that form. But then, you know, your wife can actually pull that form out and have a look at what you got and go, you never told me you got that, and you told me I couldn't go buy that because you didn't have any money, right? So you've got to be careful. We are looking at doing a safe deposit box system where we rent the box. Okay, clients put an envelope in there which is sealed, only opened by them or their nominated executor. Okay, and that will be named, and then we will safeguard that for you for a price per year. And if you need to add to it, there'll be an admin fee because we've got to turn up. But again, it means that anyone that comes here can just approach us, we give them that envelope and everything's in there. Okay, so just keep in mind that just having a will isn't always the end of the game, right?
Again, we all owe Dave a tremendous amount of thanks for this. Put a huge amount of effort into this. I have one request. If Dave drinks, you all owe a beer, so you should be drunk for the next 2 months. He literally, guys, put an extraordinary amount of effort to get us in here to this. I rescheduled just because of how enthusiastic he was to come up here to do this. But again, buy him a beer if he drinks, you know, I assume root beer if he doesn't drink alcohol. But you owe him a lot of thanks. He put a lot of effort into getting this. The venue picked us up at the airport. He's been probably the most gracious host we've had ever doing one of these things. Thank you, Dave, for it. We did available afterwards a little bit to have some conversation questions, and you can reschedule an appointment directly with us too in the future.
Now,
Well, then I'll ask a question. Any more questions?
One more thing, okay? We need to tell you our email addresses, so if you want to come back to us, you can. Okay, so my email address
Right there.
Yeah, right, Mark, it's up on the screen.
up here, right, okay,
Take a
so
picture.
Everything will be,
down.
everything will be on the
Send
YouTube
us an
video as
email.
well.
if you can, don't go on the website, okay, and register on the website with BCA, because it's not necessarily me or Ken that would then be dealing with you. So please contact us direct, or contact Thomas, and his team will put it over to us.
And what I'll do, I'll put these email addresses, phone numbers on the description of this YouTube video that's going to be up on the
Okay.
Same
Thank you
Forever
so much.
Forevermore.
We appreciate it. Thanks a
Right,
lot.
thanks for coming.
Thank you.
everyone.
Thanks, John.
Thanks very much, guys.
Thomas, could I have maybe 5 minutes?
Sure. Sure.